Welcome to Chain Reaction by Capital Copilot, your daily dose of the latest in cryptocurrency news, market insights, and blockchain trends. Let's get started. Today we're covering a major MEV bot exploit, regulatory battles, and proposals that could reshape Ethereum staking. Bitcoin is currently trading at $64,068, Ethereum at $1,747, and Solana at $73.74. Let's start with the $7.5 million exploit that hit Jared from Subway, Ethereum's most prominent MEV extraction bot. This wasn't a private key hack or smart contract vulnerability. Instead, the attacker spent weeks deploying fake tokens and liquidity pools that mimicked legitimate markets. The bot's automated systems granted ERC-20 approvals to helper contracts expecting profitable trades, but those approvals accumulated unused. Once sufficient allowances built up, the attacker drained 92 wrapped Ethereum, 143,000 USDC, and 149,000 USDT. This bot had been responsible for roughly 70% of Ethereum sandwich attacks, imposing an estimated $60 million annually in costs on traders. On the regulatory front, CME Group sued the CFTC on June 19th, challenging the agency's approval of Kalshi's perpetual futures contracts. CME argues the CFTC violated the Dodd-Frank Act by failing to analyze whether perpetuals should be classified as swaps rather than futures. This distinction carries significant regulatory implications. Meanwhile, Kraken announced it will launch the first CFTC-regulated perpetual futures for US traders within 30 days, covering Bitcoin, Ethereum, Solana, XRP, Cardano, Chainlink, Dogecoin, Litecoin, and Avalanche through Binomial Exchange and NinjaTracker clearing. In the UK, the Bank of England reversed its controversial stablecoin holding limits. Instead of capping individual holdings at £20,000 and corporate holdings at £10 million, the central bank now implements a £40 billion aggregate issuance cap per stablecoin. Reserve requirements were also eased, allowing issuers to hold up to 70% of backing assets in short-term government debt, rather than non-interest-bearing central bank deposits. Final rules are expected in 2027. A contentious proposal is generating debate within Ethereum's community. Core contributors are discussing validator redirected revenue, where validators could signal 0 to 10% of staking rewards toward ecosystem funding. If a majority supports a non-zero rate, the contribution becomes mandatory. At current staking levels, a 5 to 10% redirect could generate 50,000 to 70,000 ETH annually, approximately $120 million. Critics warn this resembles a developer mining tax and creates governance risks, as large institutional staking providers could form coalitions controlling funding decisions. Taiko halted its Layer 2 network after attackers exploited a bridge vulnerability, forging withdrawal proofs to drain approximately $1.7 million. The exploit stemmed from an SGX enclave signing key left publicly accessible on GitHub. The Taiko token declined over 20% following the incident. This represents the same vulnerability type responsible for over $340 million in losses across 14 exploits in 2026. That's a wrap for today's edition of Chain Reaction by Capital Copilot. We hope you're feeling more informed and ready to navigate the cryptoverse. Until next time, keep your digital wallets ready.